All right, so welcome back to the deep dive, where we like to, get into the nitty gritty.
Yeah, into the weeds.
Yeah, into the weeds of these earnings calls and really try to unpack, what's going on, what the company's saying, and what it means for, kind of the future of the business. And so
exactly.
Today, we're looking at Ulta Beauty.
Ticker symbol ULTA.
Yep, ULTA. Their earnings call from March 13th, 2025, covering their fourth quarter and full year 2024 results, as well as their outlook for 2025. And
right.
This one was particularly interesting because the stock actually dipped, I think, over 4% right after the call.
Oh, wow. Yeah, that's...
Clearly the market had some concerns.
Yeah, they weren't exactly thrilled with what they heard.
So we're going to try to unpack that and see if we can figure out, what was it that maybe spooked the market a little bit.
Exactly. Yeah, because while, a company can, meet their expectations for the year, it's really that forward guidance that I think gets people either, excited or a little nervous.
Yeah, absolutely. All right, so let's jump right in.
Let's do it.
To the numbers. So for the fourth quarter of 2024, Ulta reported net sales of $3.5 billion.
Okay.
Now, it's important to note here that this was over a 13-week period, whereas the same quarter a year ago was 14 weeks.
Gotcha.
So looking at it on a comparable sales basis, which adjusts for that difference in weeks, they actually saw an increase of 1.5%.
Okay, right.
Now, what's really interesting here is when you break down that growth, their average customer spend or their average ticket went up by a solid 3%. But the actual number of transactions, the number of people buying things, decreased by 1.4%.
Oh, that's interesting. So they're selling more to the same or to fewer customers even.
Yeah, and so it begs the question, right?
Yeah.
Are they attracting a different type of customer now? Are they maybe attracting a customer who's willing to spend more, but maybe they're losing some of their, more value-oriented shoppers? Or could this be a shift in behavior? Are people going to the store less often? But when they do go, they're making bigger purchases, Right. I mean, it's hard to say for sure, but it's definitely...
Yeah, an interesting trend for sure.
Yeah, it's something to keep an eye on for sure.
Yeah.
So moving on to the profitability side for the quarter.
Okay.
Their gross margin, which is basically the profit they make on their products before operating expenses, improved by 50 basis points to 38.2%.
Okay.
And that was driven primarily by a reduction in inventory shrink.
Okay.
Which includes things like theft damage.
Right.
Things like that.
Makes sense.
Their operating profit, which takes into account those operating costs, was essentially flat compared to last year at $516 million.
Yep.
But their diluted earnings per share, which is basically their profit divided by the number of outstanding shares, saw a pretty healthy increase of 4.7% to $8.46.
Okay, so, the top line comparable sales, they saw some modest growth, but they were able to, improve their gross profitability, it sounds like, mostly through that inventory management. But then that flat operating profit suggests that maybe their operating expenses are starting to rise a little bit.
Yeah, potentially.
And that boost in earnings per share, that could be due to, other factors like share buybacks potentially.
Yeah, and that's something we'll touch on a little bit later.
Okay.
So let's kind of zoom out now and look at the full fiscal year 2024. So for the full year, they saw net sales increase by a much smaller amount, just 0.8%, to $11.3 billion.
Okay.
And comparable sales for the full year also just edged up by 0.7%.
Got it.
And again, we saw that same dynamic where the average ticket increased 1.1%, but the number of transactions actually dipped by 0.4%.
Right. So that same trend seems to be consistent throughout the whole year then.
Yeah.
Yeah.
Interesting.
So it really, I think, as you said, it raises the question of, is this a strategic shift? Is this a conscious decision to go after a different customer who spends more? Or is this something else going on in the market that's affecting how often people are shopping?
Or is there maybe some economic pressure happening that's affecting consumer behavior in general?
Exactly. Now, interestingly, while sales did grow for the full year, their gross margin actually dipped slightly by 30 basis points to 38.8%.
Okay.
And their operating profit as a percentage of sales also took a hit, coming in at 13.9% compared to 15% the year before.
Okay.
And as a result, their diluted earnings per share for the full year decreased by 2.7% to $25.34 per share.
So it seems like even though they were able to grow their sales, they actually became less profitable on a per sale basis.
Exactly. And I think that's probably a big part of why the market reacted the way it did.
Right. I would imagine so. Yeah. Because they see that, even though they're growing their sales, they're becoming less profitable. So
Yeah.
that's not necessarily a great sign.
Yeah, not the direction you want to see things moving, for sure.
No, definitely not.
Yeah.
Okay, so now let's get to what's probably on everyone's mind, which is what are they projecting for fiscal year 2025?
Right, the future.
Yeah, exactly, the crystal ball. So for fiscal year 2025, they're projecting net sales to be in the range of $11.5 billion to $11.6 billion.
Okay.
So a little bit of growth,
Yeah.
but not a ton. Their comparable sales growth is only projected to be between flat and up 1%.
Okay.
So that's a noticeable slowdown from the 0.7% they achieved in fiscal 2024.
Right. So that's almost flat, basically, for their comparable sales growth. And that's definitely a concern, right? Because, I mean, it's one thing to see profitability go down, but if your sales aren't growing either, then you're kind of in a tough spot.
Yeah. And that's where I think, it starts to become concerning. And the outlook on the profit side isn't much better. So they're actually expecting their operating profit to decrease in the low double-digit range,
Oh, wow. Okay.
which translates to an anticipated operating margin of between 11.7 and 11.8%.
Okay.
And their diluted earnings per share is forecast to be between $22.50 and $22.90 per share.
Okay. So that's a significant drop from that 25.34
Yeah?
they reported for 2024.
Yeah. So just to kind of summarize the guidance here.
Yeah.
Very minimal sales growth and a pretty substantial decline in profitability.
So not painting the rosiest picture for the year ahead.
Yeah. Yeah. So definitely a transition year, as they put it.
It's either a transition year or it's a we need to figure some things out year.
Yeah. Yeah, exactly. So let's dive into now what's driving these numbers and more importantly, what is Ulta's plan to address these challenges?
All right, let's get into the strategy.
Yeah. So they're really leaning heavily on this thing they call their Ulta Beauty Unleashed plan, which centers around three main things driving growth within their core business.
Okay.
Scaling new businesses that can kind of add to their earnings, and then just fundamentally realigning their operations for the future.
So, that third one, realigning their foundation, that suggests that they know they need to make some changes.
Yeah.
Pretty significant ones, maybe to adapt to what's happening.
Yeah, exactly.
Yeah.
So within this plan, they're talking about improving the in-store experience.
Yeah.
Things like making the stores easier to navigate, making sure the shelves are stocked.
Right, the basics.
Yeah, the basics, having enough staff, having a clean, inviting atmosphere.
Yeah, all that good stuff.
Yeah, exactly. And then they're also focusing heavily on brand building. So investing in exclusive brands,
Okay.
emerging brands and well-established brands, a mix of all that. And some of the launches they highlighted for 2025 were Milk Makeup
Okay.
and Nua, which is a K-beauty brand exclusive to Ulta.
Interesting.
And then get this, Beyonce's hair care brand, Secret,
Oh, wow.
also exclusive.
Interesting. So getting into some big name, celebrity brands there.
Yeah, and that's,
Especially that Beyonce one, that could be huge.
yeah, I think that's a smart move.
Yeah.
They have so much data on their customers, they can really start to use that to personalize those offers and those communications, and really, drive that engagement and loyalty even further.
Right. Give people what they want before they even know they want it.
Exactly.
Yeah.
Yeah, and then another interesting thing is that they're making a pretty significant push into wellness.
Oh, wow.
Yeah.
Interesting.
So they're planning to add at least 20 new wellness brands in 2025.
Wow.
And they're exploring all these new categories, beyond just traditional beauty, like nutrition mindfulness products, everyday personal care items, even sleep-related products.
Wow. So they're really getting into that whole holistic well-being kind of.
Yeah.
Yeah.
Yeah. And they're even considering expanding the in-store presentation of these wellness offerings in select locations.
So it's not just online, it's also going to be in the stores.
Yeah. Yeah. So it's a pretty big deal.
That's a big expansion.
Yeah. And I think, it makes sense, right? Because the beauty and wellness connection is becoming more and more of a thing.
Yeah, absolutely.
People are realizing that, beauty is not just about what you put on your face. It's about...
Right. It's how you feel overall.
Exactly. So
Yeah.
I think it's a smart move for Ulta to kind of tap into that trend.
Yeah, I think so too. But it'll be interesting to see, how they curate that new assortment
Yeah.
and how it resonates with their existing customer base.
Yeah. And if they can, get those people who are already coming to Ulta for beauty to start, buying wellness products as well.
Right. Expand that basket size.
Yeah, exactly. And speaking of expanding their reach, they're also planning to launch a new e-commerce marketplace in the back half of 2025.
Oh, okay.
So this will be an invitation-only or closed marketplace.
Okay.
And it'll offer a much wider range of beauty and wellness products than they currently carry themselves.
Got it.
But importantly, customers will still earn loyalty points on those marketplace purchases.
Okay.
And they'll be able to return items in Ulta's physical stores.
So they're really trying to make it like a seamless experience between the marketplace and their own product.
Exactly. And I think that's really smart because, kind of brings that trust factor in.
Right, because people already trust Ulta.
Yeah.
So if they're buying through the Ulta marketplace, even though it's not an Ulta product, they still kind of have that Ulta backing them up,
Exactly. And they're incentivized to use it because they're still earning points.
Right, exactly.
So I think that's a really interesting move.
Yeah, I think so too. And I think it's smart for Ulta to do it that way because they don't have to invest all the capital in actually stocking all those additional products.
Yeah.
They can kind of let other companies take on that risk and then they just kind of, get a cut.
Yeah.
Of the sale.
Exactly. So internationally, Ulta announced plans to launch in Mexico and expand their presence in the Middle East in 2025. So,
okay.
They're definitely thinking globally as well.
Yeah.
They're thinking big. Yeah. And they're also going to be enhancing their Ulta Beauty media platform, which basically provides advertising opportunities for brands within Ulta's ecosystem.
Yeah.
So they're going to be introducing some new product innovations there and giving brands better ways to kind of measure the effectiveness of their campaigns.
Right. So they're kind of becoming their own little advertising platform almost.
Yeah, exactly. And I think, that could be a really interesting revenue stream for them.
Yeah, for sure. And it also helps, strengthen their relationships with their brand partners.
Yeah.
'Cause they're offering them more value.
Exactly.
Yeah.
And then finally, a key part of this Unleashed plan involves realigning their organization.
Okay.
So they're making some changes to try to streamline decision-making processes.
Okay.
And optimize their cost structure.
Yeah, that makes sense.
And they've made several changes to their leadership team,
Okay.
including creating a new chief retail officer to oversee all store operations,
Okay.
expanding the role of their chief technology and transformation officer,
Okay.
and they've combined the roles of chief merchandising and digital officer into one.
Okay.
Although that person is actually retiring later this spring. They've also appointed a new chief marketing officer, and they're welcoming a new chief legal officer next month.
Wow. So that's a lot of change happening at the top.
Yeah, big shakeup.
Yeah.
Yeah, and I think, it just goes to show how seriously they're taking this kind of transformation.
Right. They're not messing around.
Yeah, exactly. And on the cost side, they're targeting $200 to $250 million in cost optimization over the next 3 years.
Wow. Okay.
Which builds on the $550 million they've already saved since 2019.
So they've already been working on this for a while.
Yeah. And I think, this focus on efficiency is going to be really crucial given their profit outlook.
Yeah, it sounds like they're going to need to achieve those savings if they want to hit their targets.
Yeah, absolutely. Okay, so let's dig into some of the specific financial details that they shared a little bit more.
Okay.
So they talked about how sales trended throughout the fourth quarter, and they said they saw a decrease in November followed by a pickup in December.
Which makes sense, right? With the holidays.
Yeah, it makes sense. And then a slowdown in January, which they attributed to weather.
Oh, okay. Interesting.
But if you combine November and December, their comparable sales actually increased in the low single-digit range.
Okay. So that holiday period was still pretty strong for them overall.
Yeah, for sure. And then looking at how different parts of their business performed in Q4, both their physical stores and their digital channels saw growth.
Okay.
So e-commerce sales increased in the mid-single digit range.
Right.
And what's really interesting is their comparable store sales were actually modestly positive, which was an improvement from the third quarter. So that suggests that maybe their efforts to improve the in-store experience are starting to work.
Right. I mean, that's a great sign, especially because, it seems like, everyone's always talking about how e-commerce is eating everyone's lunch.
Yeah.
But the fact that they were able to improve their in-store performance is pretty impressive.
Yeah, I think so too. And then breaking down sales by category in Q4, fragrance was the clear winner, delivering double-digit comparable growth.
Wow. Okay.
Skincare saw a mid-single-digit increase with strong performance in body care, offsetting some declines in prestige and mass skincare.
Okay.
Hair care grew low single digits. And then makeup actually saw a mid-single-digit decrease, primarily driven by weaker sales in mass makeup.
Okay.
And their services business saw a low single-digit increase.
So
Yeah.
kind of a mixed bag there, but, fragrance really.
Yeah, fragrance is really
And carrying the team.
yeah, carrying the team. And I think, that speaks to a broader trend we've been seeing in the beauty industry.
Yeah, I think so too. And that dip in mass makeup, that's also something to keep an eye on, right? Because maybe that's a sign of, shifting consumer preferences or maybe just increased competition in that segment.
Yeah, for sure. So we talked about gross margin earlier, but just to kind of recap, the increase in Q4 was mainly due to that lower inventory shrink.
Okay.
But they also benefited from selling more through their online channels, which tend to have higher margins.
Right.
And they also had better pricing on their merchandise. However, these were largely offset by increased costs in their supply chain, lower revenue from their credit card program,
Okay.
and the fact that their fixed costs for their stores became a larger percentage of revenue as sales growth slowed.
Right.
And then for the full year, the decrease in gross margin was primarily due to those costs associated with store occupancy and their supply chain, partially offset by that improvement in inventory shrink.
So, they're making progress in controlling those inventory losses, but they're still dealing with those higher costs from their, physical store network.
Yeah,
And all the supply chain challenges that everyone's been facing.
exactly. Looking at their SG&A or selling general and administrative expenses in Q4, those were actually slightly lower compared to the same period last year,
Yeah.
mainly because of reduced spending on corporate overhead, specifically consulting expenses.
Okay.
However, this decrease was partially offset by higher costs for store payroll and employee benefits, driven by, things like healthcare costs more staffing during the holidays
Right.
and higher wage rates.
Yeah. Those are all, pretty common trends these days, unfortunately.
Yeah. And as a percentage of their sales, SG&A actually increased. And for the full year, SG&A saw a bigger increase due to all the strategic investments they've been making.
So even though they're cutting costs in some areas, they're also investing heavily in other areas, which is, probably putting some pressure on their margins.
Yeah, exactly. And I think, that's something that's important for investors to understand is that, they're making these investments for the long term, but in the short term, it's going to put some pressure on their profits.
Yeah, it's a bit of a balancing act, right, between investing for the future and delivering results today.
Exactly. Their inventory levels at the end of the year were up by 13% compared to the previous year.
Okay.
And they said this was mainly to support new brand launches, new store openings, and just to make sure they have enough of the products that people want in stock.
Okay.
And the biggest increases in inventory were in fragrance and body care.
Which makes sense because those were their strongest category.
Yeah, exactly. And then in terms of how they're using their money in fiscal 2024, Ulta generated $1.3 billion in cash from their operations.
Oh, okay.
They reinvested $374 million back into the business through capital expenditures.
Okay.
And they returned $1 billion to shareholders through stock buybacks,
Okay.
bringing the total amount they've returned to shareholders since 2014 to $6.8 billion.
So they're, investing in the business, but they're also, giving back to their shareholders.
Yeah.
Which is, always a good sign.
Yeah, exactly. And I think it shows that they're confident in their ability to generate cash flow in the future.
Right.
Okay, so now let's talk about why they're expecting those lower profit margins in fiscal year 2025.
Okay, let's get into the nitty gritty.
Yeah, so they basically said it's going to be a combination of things. So ongoing inflationary pressures,
Okay.
particularly on wages, healthcare costs for their employees, and transportation expenses.
Right. So the things that everyone's been dealing with for the past couple of years.
Yeah, the impact of past investments in things like software as a service and depreciation on their assets.
Okay.
The strategic investments they have planned in brand building personalization, digital platforms, the wellness initiative, the new marketplace.
Right. So all the new stuff they're doing
Yes.
is going to cost money.
Yeah. And then also they expect incentive compensation for their employees to be a headwind as they lap against lower payouts from 2024.
Okay.
So they're saying that, this year they're going to have to pay their employees more because last year they paid them less.
Right.
So that's going to be a hit to their profitability.
Okay.
Now, they do anticipate that some of these pressures will be offset by continued improvement in inventory shrink,
Okay.
efficiencies in their supply chain benefits from their Ulta Beauty media platform,
Okay.
and the cost optimization efforts that we talked about earlier.
Right. So they're trying to find savings where they can
Yeah, exactly.
to offset some of those increased costs.
Exactly. And they're projecting that their gross margin will decrease slightly due to store occupancy costs and supply chain expenses, partially offset by lower shrink.
Okay.
And they expect their SG&A expenses to increase by about 10%.
Okay. So, their costs are going up in a lot of different areas, but they are trying to find ways to save money.
Yeah.
So it'll be interesting to see, if they can actually achieve those savings.
Yeah. And they also have a significant amount of capital expenditures planned for fiscal year 2025 in the range of $425 to $500 million.
Wow. Okay.
And this will cover things like new store openings, remodeling existing stores, updating fixtures, improving their supply chain, investing in IT infrastructure, and general store maintenance.
So a lot of spending planned for the year ahead.
Yeah.
Yeah.
And they expect depreciation expenses to be between $290 and $300 million.
Okay. So just to kind of recap here, it sounds like they're facing a lot of headwinds in the coming year.
Yeah.
Inflation's still a problem. They've got all these strategic investments that are costing money.
Yeah.
Their costs are going up in a lot of areas, and they're planning to spend a lot of money on capital expenditures.
Yeah.
So it's going to be a challenging year for them from a profitability standpoint.
Yeah, for sure. And, it's interesting because they're still projecting some sales growth.
Right.
But it's just not enough to offset all those cost increases.
Right. So it's not that they're, expecting their business to decline.
Yeah.
It's just that they're expecting their costs to increase faster than their sales.
Exactly. And that's a tough spot to be in.
Yeah. And it's kind of a common theme that we've been seeing across a lot of different companies lately.
Yeah.
Inflation is just eating into everyone's margins.
Yeah.
And it's forcing companies to make some tough decisions about, where to cut costs and where to invest.
Exactly. Okay, so finally, let's talk about how Ulta sees the competitive landscape and their own market share. So they acknowledged that they lost some market share in the beauty category in 2024, citing increased competition from both online retailers and other brick-and-mortar stores.
Right. So the competition's heating up.
Yeah, and they expect that this competitive pressure will continue throughout 2025.
Okay.
Although they expect the impact to be less severe than it was in 2024.
Okay.
And they mention that over 9% of their current stores have been affected by recent competitive store openings.
So new stores popping up near their stores
Yeah.
and kind of stealing some of their customers.
Yeah, exactly. And, I think that's a sign of how competitive this market is becoming.
Right. It's a tough business.
Yeah. And so their focus now is on executing their Ulta Beauty Unleashed plan effectively.
Okay.
To regain momentum and drive profitable growth. And, basically they're saying they need to focus on what they can control internally.
Right, because there's only so much they can do about the competition.
Yeah, exactly.
But they can control, how they run their own business.
Exactly. And they also provided some context around their guidance and the overall macroeconomic environment. So they said they're mindful of the ongoing economic uncertainty and potential shifts in consumer behavior.
Oh.
Which is why they're taking a cautious approach to their fiscal year 2025 guidance, and they're basically framing it as a transition year.
Right.
However, they're still optimistic about the overall health of consumer engagement in the beauty category.
Yeah.
They're anticipating low to mid single-digit growth overall.
Okay.
And they think that's going to be supported by the increasing connection between beauty and wellness,
Okay.
the continued rise of digital engagement, ongoing product innovation,
Okay.
and sustained consumer interest in beauty.
So they're not saying that the beauty market is dying or anything.
Yeah.
They're just saying that it's going to be a challenging year.
Yeah.
For Ulta specifically.
Yeah, and they also anticipate that the promotional environment will remain relatively stable with a focus on, optimizing the timing and effectiveness of promotions
Okay.
and leveraging their customer loyalty program data for more targeted offers.
So they're going to be smart about how they promote.
Yeah, exactly.
And they're going to use their data to make sure they're targeting the right customers with the right offers.
Exactly. All right, so I think we've pretty much covered everything.
Yeah, I think we've hit all the main points.
So now for our favorite segment
Oh, yeah.
where we put on our speculative investor hats.
The outrageous but plausible.
Yeah, outrageous but plausible trade ideas.
Mm-hmm.
And so, given everything we've talked about, I think there's an interesting trade here.
Okay. I'm intrigued. Let's hear it.
All right, so the thesis is basically to go long Ulta Beauty,
Okay.
but at the same time short a traditional department store chain that has a limited presence in beauty and wellness
Okay.
and that might be vulnerable to online marketplaces.
Okay. So kind of like a pairs trade.
Yeah, exactly.
Interesting.
So the thinking here is that Ulta is making this big push into wellness.
Right.
And their new online marketplace could really expand their reach
Right.
and their product offerings without requiring a lot of capital investment.
Right.
And that could potentially attract a whole new customer base
Mm-hmm.
or allow them to get more spending from their existing customers
Right.
because now they're meeting more of their needs.
Right. They're a one-stop shop for all things beauty and wellness.
Exactly.
Interesting.
And at the same time, these traditional department stores, they're kind of stuck in the middle.
Yeah.
They're not really specialized in beauty and wellness, but they're also not as nimble as online marketplaces.
Right.
So they're kind of getting squeezed from both sides.
Yeah, they're kind of stuck in no man's land.
Yeah, exactly. And I think as consumer preferences continue to shift towards more specialized and integrated shopping experiences,
Yeah.
these department stores are going to have a tough time keeping up.
Yeah, I think you're right. And, we've already seen some department stores struggling in recent years.
Yeah.
So this trade is kind of betting that that trend is going to continue.
Exactly. Now, of course, huge disclaimer here.
Yes.
This is just a hypothetical trade idea.
Right.
This is not financial advice.
Don't go out and make any trades based on what you heard here.
Please do your own research.
Yes. Do your own due diligence.
Consult with a financial professional
Absolutely.
before making any investment decisions.
This is just for entertainment purposes.
Yeah, for fun.
It's a thought experiment.
Exactly. All right, so that concludes our deep dive into Ulta Beauty's latest earnings call.
Yeah, I think we covered it all.
I think so too. We talked about the financial results,
Right.
the strategic plan, the competitive landscape, the macroeconomic environment.
The good, the bad, and the ugly.
Yeah, exactly. And hopefully this gave you a better understanding of what's going on at Ulta Beauty.
And maybe some things to think about in terms of broader retail landscape.
Yeah, for sure. So what are your key takeaways from this deep dive?
Here.
Are you intrigued by their expansion into wellness or the potential of their new marketplace?
Yeah. What are your thoughts, listeners?
Yeah, what questions does this raise for you about the future of beauty retail?
Yeah, let us know in the comments.
Yeah, and we encourage you to check out Ulta Beauty's earnings release yourself and see, what you think.
Yeah, and do your own research.
Yeah, exactly. All right, so join us next time on The Deep Dive as we unpack another crucial earnings call.
Yeah, we'll be back with another deep dive soon.
Until then, thanks for listening.
See